Buenas tardes. I'm afraid I'm going to speak in English, but aprendiendo español. Thank you very much for your time and your attention. In the next 15 minutes, I want to introduce to you a different way of investing in Asia ex-Japan. Just a little bit about us. We run currently $4.5 billion. We are now in our 14th year. The same team has been in charge of the strategy from the very beginning. We run a high conviction fund. There are 60 positions in our portfolio. Our top 10 are typically around 40% of our weight. The first way we're different is our contrarian investment approach. That means our focus is on where we find the most attractive price relative to value opportunities, and we are indifferent as to the quality of company that we are buying. We tend to find the most interesting opportunities in out-of-favor sectors, in unloved markets. This is a very bottom-up driven approach, and it results in a portfolio that looks very different, as you'll see in a few minutes, relative to our peers. We've delivered just over 9% annualized return over the 14 years we've been running the fund, and circa 5.5% alpha. And this is our longer-term strategy performance. The dark blue line is us, the light blue line is our benchmark, the All Countries Asia ex-Japan Index. And the green bars are the relative annualized outperformance that we've generated. And you can see that's been pretty consistent over our history. You'll also see that 2020 was a bad year for us. It indicates a little bit as to what we do. That was a COVID year, a year of go-go growth, a year when expensive stocks got more expensive, cheaper stocks got cheaper. That's quite challenging for our contrarian approach that certainly relies a little bit on mean reversion. We want cheaper stocks to be less cheap and expensive stocks to get cheaper. In our worst year, we delivered a 12% absolute return for our investors, so I'd like to think there are worse outcomes than that, and clearly in the last few years we've gone some way to make back the difference. So the first way we're different, if you imagine companies plotted on a price-quality spectrum, as we've done here, most would be the white dots sitting along a line of fair value, and that goes to the relationship between price and quality. You expect to pay a high price for a high-quality company, a lower price for a lower-quality company. We're looking for the dark blue dots below the line. So we're agnostic as to the quality of company that we're buying. If we can find a Ferrari at $50,000, then we're very happy to own a Ferrari at that price. But we're equally happy owning a Ford further down the quality spectrum at $5,000. Now, in the life of our strategy history, we've certainly found Fords to be more attractively valued relative to Ferraris. And you think about Ferraris in that go-go growth year, that was a year when investors were prepared to pay $1 million for a Ferrari. Today, in probably the most unloved market around the world, China, which is probably the ultimate contrarian play, both growth and quality companies are on sale at attractive prices alongside value. Everything in China is for sale at the moment. So that's the first way we're different. We'll flex up and down the quality spectrum depending on where we find the most attractive opportunities. And the second way we're different, I said that we like buying out-of-favor companies. This is some analysis that demonstrably shows you in aggregating all of the purchases we've made, what share prices do prior to the purchase and after we've purchased. The right-hand side shows you the share prices of our companies have gone on to outperform. That confirms our ability to generate alpha. What's a very different construct is the left-hand side here, and you can see that we are indeed buying or investing into companies whose share prices have been falling prior to our investment. Now, it's our job to assess that that is for a temporary reason, maybe cyclical companies at a trough point in their earnings cycle. Of course, we want to avoid companies that are cheap for a good reason, that they're in permanent decline. But that's a very different construct from our peers. The good ones will look the same on the right-hand side, but on the left, the inverse, of course, momentum has been a very important factor for investors over the last several years, and our peers have typically bought into share prices of companies that already started to reflect an improvement in earnings. So that's the second way that we're different. We are demonstrably contrarian when others have been momentum. So where are the blue dots? Where are we finding the opportunities today? And this shows you how value has done relative to growth. The shaded grey is the life of our strategy. And you can see it's been a graveyard, a really tough place for value investors. It probably shows you the first mistake we made was to not buy growth at the beginning, and value has been in a prolonged period of derating relative to growth. But it also shows you why we've been buying more Fords than we have Ferraris in our history. And even though we have started to see a little bit of a re-rating for value relative to growth in the last few years, this is the area we see the greatest opportunity today. There has been price adjustment for those Ferraris that were $1 million, or investors paid $1 million for, but we still continue to see the opportunity in value relative to growth. Now, another way of looking at it, where are we finding opportunities at a market level? And this looks at the US dollar returns of the 4 major markets within Asia ex Japan, and we show them here against the dark blue line, the S&P 500. And you can see that indeed has been the best major market globally over the last decade. 2 of our markets, India, the grey line, and Taiwan, the orange line, have given investors a decent return over the last 10 years. Not quite as good as the S&P, but a good return. What hasn't done well? The green line, the Kospi Korean index, has basically gone nowhere over the last 10 years. And the 2 at the very bottom are the Chinese indices. The blue is the Hang Seng China Enterprise Index. The red is US-listed Chinese companies. They basically lost investors' money over the last decade. So perhaps unsurprisingly, given our contrarian approach, you see here our relative country and sector positioning. And this immediately shows you how different we are. We have a big overweight to Korea, a big overweight to China, the 2 worst performing markets over the last decade. But the markets where we find across that quality spectrum exceptional valuations, really high quality companies at attractive valuation levels and lower quality companies at exceptional prices. At the other end of the spectrum, you'll see we have a very big underweight to India. In fact, we have just 1 position in that market. We like India top down. We don't have some contrarian view on India's progress, on reform momentum, on benign demographics, consumption, China +1 manufacturing. We like all those things. What we don't like is the price that we're expected to pay. And at 20 times PE, India is trading more expensively than even the S&P 500, which we saw before has been the best performing market. And I would argue India is very different in terms of the quality that you're getting. So our underweight there, we have a single position, is driven by our struggle to find attractive opportunities compared to markets like Korea and China. Now, Taiwan, you'll see we're also underweight. In essence, we don't own TSMC. I'm sure most of our peers will have that in their top 3 positions. Our view is that we see downside risk to earnings for TSMC, also for the logic supply. A lot of those companies sit within the Taiwan market. And our sector positioning, similar. I guess the underweight information technology reflects our underweight to Taiwan tech and particularly to TSMCs. And financials. That's a good illustration that we don't buy anything just because it's cheap. We don't own any Chinese banks. And our view there is they massively understate the non-performing loans on their books. but also, as you're seeing today, the call to national service to stabilize and rescue the private developers in the property sector. Now, thinking about China, as I said a few minutes ago, it's been the ultimate contrarian play. It divides opinion as to whether it's even investable or uninvestable. And you can see that bearish sentiment alongside the challenges that China is facing in property, in weaker consumption, in slowing growth, has led to the huge discount relative, and this is the Hang Seng China Enterprise Index relative to the rest of the world. China's never been cheaper. We're back, in fact, the Hang Seng China Index is now back at the level we last saw in 1993. You could say 3 lost decades, but for us as contrarian investors, negative news equals attractive valuations. You never get good news and attractive prices, and in fact, the last time investors were super bullish on China was post the financial crisis, when, of course, China did issue $1 trillion stimulus, which the world was hoping they would, and in fact, they're hoping they would this time. Now, we think the market is overly discounting the risks in China, and you've seen, certainly, although we haven't had the bazooka-style stimulus that everyone has been expecting or wanting to see, you've seen the government going through the fiscal and monetary policies gears. We're starting to see a green light at the end of the tunnel. Now, we temper our overweight China, because although the valuations are exceptional, we're not all in, because the one risk that does keep us awake at night is the geopolitical tension between China and the US. But even last week, with Xi and Biden meeting at the APEC in San Francisco, you could say today that that risk has de-escalated, certainly a lot lower than where we were. And now in Taiwan, we have the opposition parties going in on a joint ticket that even makes the prospect of a pro-China party being elected democratically in Taiwan that may escalate that tension. So China, we think, is overly discounting the risks, and there we find exceptional valuations. Just to put some numbers, and ultimately, we're in the business of buying and investing in companies cheaply and selling them when they get more expensive. And when you look here against our peers, you can see we're the only fund sitting out in large cap value. That's been a pretty lowly place to be the last 10 years plus. We've survived because we weren't just in the value. We had some Ferraris alongside the Fords. But you can see in the table just how cheap our fund is today. 0.7 times book, that's below liquidation value. At 8 times P, we're half the level of the benchmark. Now, there's no such thing as a free lunch in investment. So what's the price for being so cheap? You're going to be lower quality. And when you look at our return on assets, return on equity in the fund, yes, we are lower than average quality, but not by much. And as a starting point, as we look out over the next 3-5 years, we think this stacks the odds in our favor for delivering a decent return outcome, given how exceptionally cheap the fund is and how reasonable the quality, given that valuation, is in the fund. Now, we've delivered, and in fact, we're number one out of our peer group, unashamedly going to say that, over the life of the strategy. Now, normally for fund selectors, that's a red flag. You never want to buy a top-performing fund because that's normally a precursor for underperformance. But we've delivered that outperformance despite what has been a hostile condition where we've been value, growth has been the place to be. We've been contrarian where momentum has worked. We've been lower than mega cap when mega cap has been the place to be. So I'd love to leave you with a thought as to what our fund performance might look like if some of these headwinds became tailwinds alongside our ability to generate alpha. Just a quick flash that some of the cheaper names in the fund, how do we protect on the downside? These businesses are generating decent cash flow. You've got a third of the fund giving you a 7% dividend yield. And finally, I think our contrarian absolute return mindset particularly lends itself to a volatile asset class as Asia ex-Japan is, and China, which has certainly been a boom-bust investment over the last 2 decades. But in every year that our benchmark has had a negative return, we have delivered a better outcome for our investors. And that means they're less likely to be shaken out at precisely the wrong time. And I would argue today that is the case with China, given where we are with valuation. So I'm up on the clock. Do get in touch with my colleague Melanie, who runs our distribution here. Thank you so much for your time this afternoon.